Welcome back to The Explainer. Today, we're diving into the crypto markets for June 11th, 2026. And to really capture the sheer intensity of the data we're looking at today, we've styled the visuals for this one like a dynamic anime battle arc. Think smooth vector animations, really vibrant comic colors. Why? Because right now, the market is literally locked in this high-stakes clash. On one side, our main antagonist, these crushing macro headwinds. And on the other side, this massive, unyielding wall of institutional building. It's an epic standoff between sheer market panic and solid underlying foundations. Let's get right into it. So the battlefield is tense, the strikes are heavy, momentum is shifting constantly, and the biggest question flashing across literally every trader's screen right now, can the $60,000 shield hold? Let's find out. Section 1. The threat. Macroeconomic pressures. Now, the psychological toll of this threat, it's immense. The crypto fear and greed index has plummeted all the way down to 13. We are deep, deep in the territory of extreme fear. Market participants are anxious, to say the least, and that heavy negative sentiment is acting like a massive gravitational pull, just dragging down prices and completely halting any short-term momentum. And the weapons this antagonist is wielding are raw economic data points. The U.S. Producer Price Index just spiked to 1.1%, completely shattering 0.7% consensus. Paired with recent CPI inflation hitting 4.2%, it reinforces this terrifying higher-for-longer interest rate environment. For non-yielding assets like Bitcoin, this acts like a relentless barrage of selling pressure. Higher yields and a really steady U.S. dollar are aggressively pushing back against any attempts at a market rally. And the hits just keep coming from the real world. We're seeing fresh U.S.-Iran military strikes in the Middle East, casting serious doubt on ceasefire negotiations. That instability, it's caused oil prices to surge by 3%, which, you guessed it, only adds fuel to the inflationary fire. Because of all this, Asian equity markets and broader risk assets are facing severe downward pressure. Right now, the macro environment is aggressively risk-off. Which takes us to Section 2, the last line of defense, critical supports. Okay, let's dive into this because the contrast here is staggering. Bitcoin is desperately trying to defend that definitive $60,000 support wall. If that breaks, the dominant bearish trend line extends. But smashing against that very wall is $1.72 billion in weekly Bitcoin ETF outflows. That is massive institutional capital flight, guys. It makes this one of the largest withdrawal weeks in all of 2026. The shield is taking incredibly heavy damage right now. Delivering this like an urgent battle report. The casualties are definitely piling up. The broader crypto market has shed $390 billion in value. To put that into perspective, we're looking at the worst week since the FTX collapse. Ethereum has fallen below its critical $1,600 level amidst all this fierce competition and outflows. And the altcoins, they are bleeding. Cardano, for instance, is currently testing a very fragile 16-cent support. And we aren't just fighting macroeconomic forces here. Secondary antagonists are actively breaking through the perimeter. Security exploits are seriously compounding the damage. Over just the last 6 months, $36.7 million has been lost specifically to AI-driven attacks targeting unverified smart contracts. And that's right alongside a fresh $1.34 million exploit on Radium. The perimeter is definitely being breached. But wait, here is Section 3, the counterattack, global regulatory shifts. Let's rapidly break down this global regulatory battlefield because the momentum actually is shifting. Look at Japan. They just slashed their crypto tax from a punishing 55% all the way down to 20%. That's a massive structural victory that paves the way for new ETF approvals. Over in Hungary, they're actively rolling back strict rules that previously carried 8-year prison terms, essentially decriminalizing crypto transactions. Meanwhile, in the US, we're looking at a political stalemate. A GOP-backed crypto tax bill is facing pushback from House Democrats, and it's currently stalled over whether to exempt staking and mining rewards from reportable income. So it's a very complex landscape, but internationally, the structural wins are huge. And amidst all this market chaos, permanent infrastructure is actually being built. Japan's 3 largest megabanks are teaming up to issue joint stablecoins by March 2027. Over in the UK, the Financial Conduct Authority proposed allowing retail mutual funds to hold up to 10% of their portfolios in crypto. That is a major milestone for mainstream acceptance. Plus, progress on the Clarity Act in the US is aiming to finally define token classifications. All right, Section 4, institutions enter the arena. Let's move on and see how this builds, because the institutional timeline is accelerating right through the market fear. First up, BlackRock updates its filing for a new Bitcoin Premium Income ETF. They are racing to monetize this volatility. Then, Citibank launches a blockchain platform specifically for tokenized private equity trading for its wealthy clients. And get this, SpaceX tokenized shares, known as SPCX, are launching on the Solana network the very same day the company is expected to list on Nasdaq. The bridge between traditional finance and on-chain assets is being built at lightning speed. Boom, $1.4 billion. That is the size of the funding round led by Tether for the German robotics company NEURA. So while retail investors like you and me might be sweating the daily charts, stablecoin giants are out here deploying over $1 billion to strategically expand into artificial intelligence and robotics. Wild. But playing at the institutional level requires colossal conviction and obviously immense risk. Corporate whale Bitmine aggressively bought the dip, scooping up nearly 127,000 ETH for $214 million. But because of the massive market drop, Bitmine's total Ethereum treasury is now facing a staggering $9 billion unrealized loss. Yeah, $9 billion with a B. That is a jaw-dropping gamble, really highlighting the extreme volatility these massive players can stomach. Which takes us to Section 5, the new meta, real utility and cash flow. So the crucial point here is how the smart money is migrating right now. Step 1. Capital is actively fleeing pure hype in those old narrative-driven projects. Step 2. It's migrating directly into stablecoin payment infrastructure. We see this with projects like M0 Protocol, raising $35 million. And Step 3. Institutions are desperately seeking real yield and actual cash flow through compliance-based derivatives. Simply put, they want actual revenue, not just a good story. This quote from KuCoin Research really captures the new reality perfectly. Protocols that genuinely generate cash flow can establish a valuation system independent of market sentiment. A perfect example of this is the decentralized trading platform Hyperliquid. They are generating over $700 million in annualized revenue. That kind of actual, undeniable utility acts as the ultimate armor against extreme market fear. So to summarize what we are seeing in this explainer today, the visible market, the tip of the iceberg, is obviously struggling with ETF outflows and broken supports. But the massive underwater buildout, that is the true counterattack. Stablecoin payment networks, tokenized real-world assets, and decentralized AI computing networks are securing massive funding, and they are quietly building the infrastructure for the future. Which leaves us looking at the horizon of this battlefield. As retail investors succumb to extreme fear, the heavy-hitting institutions are relentlessly building and deploying capital. The macro headwinds are fierce for sure, but the structural foundations have literally never been stronger. So as we look ahead, who will ultimately win the battle for the next cycle? Keep learning, keep watching, and we'll see you in the next explainer.